Tony Robbins, Money Master the Game, 7 Simple Steps to Financial Freedom. Embark on a transformative journey to master your financial fate with Tony Robbins, Money Master the Game, 7 Simple Steps to Financial Freedom. This book summary presents valuable insights and lessons from America's most successful investors as they unfold the key principles to achieving financial independence. Along the way, you will unravel the power of compound interest, the hidden fees that eat away at your investments, and the vital importance of asset allocation. Unveiling the myths that surround conventional wisdom and providing practical retirement savings strategies, this comprehensive guide will empower you to take control of your financial life.
Follow these 7 principles. The path to wealth is littered with mistakes, but successful investors have learned from these mistakes and have adapted to various economic conditions with discipline and knowledge. The 7 steps they suggest revolve around the ultimate goal of saving for retirement. Retirement savings pose a challenge, but with the probability of spending 25 to 30 years in retirement, investing becomes necessary. However, this may be intimidating for some due to its emotional component. By following the 7 principles, investing and financial stability can be attained. Additionally, they suggest that sharing with others is essential to not only a greater quality of life but can also bring joy. The power of compound interest. Discover how the mathematical force of compound interest could help you achieve financial freedom and make your money work for you. Compound interest is one of the most potent tools in finance, and it can work wonders for your savings goals. The American founding father Benjamin Franklin understood this principle well and bequeathed $1,000 each to the cities of Boston and Philadelphia with a stipulation not to withdraw the money for 100 years. After that period, each city could withdraw $500,000, and by the end of 100 years at an 8% compounding interest rate, the money grew to a whopping $6.5 million. To achieve financial freedom, becoming an investor is essential. You need to shift from being a consumer in the economy to being an owner. The power of compounding offers a way to make your money work for you, not vice versa, regardless of your earning power. Therefore, it is crucial to start saving or investing early and leave your money to compound. Saving a percentage of your income every month is the first step towards achieving your financial goals. Once you have a critical mass, the compounded returns can last a lifetime. Therefore, it is vital to use automatic paycheck deductions to save before you can access your income. With the power of compound interest, you can make your money work for you tirelessly, providing a source of passive income. Investing myths debunked. Learn the truth about investing in this book as it debunks common myths, misconceptions surrounding investing, particularly on the role of brokers and fees. Investing is a necessary aspect of ensuring a financially stable future. However, investing comes with its own set of myths and misconceptions that one must know to navigate successfully. In this book, the author debunks these myths and clarifies common misconceptions surrounding investing. One myth is the belief that brokers will always act in your best interest. This myth is far from the truth because many financial managers fail to beat the performance of index funds over time. Shockingly, only 8 out of 200 fund managers beat the Vanguard 500 index from 1984 to 1995. Therefore, investing in a less costly index fund is better than paying high fees to an active financial manager. It's also crucial to consider the impact of fees on your bottom line. Investors mistakenly overlook fees on funds, which can significantly impact their overall returns. Annual fees of 1%, 2%, and 3% on a $1 million portfolio over a 30-year period may result in an $7.6 million, $5.7 million, and $4.3 million, respectively. In essence, investors can assume market risk with little or no return while still paying the fund manager $30,000. Moreover, pension fund administrators also charge fees on top of mutual fund fees, which can add up to 3.16% of a non-taxable account and 4.17% of a taxable account. As an investor, reducing costs is paramount, including the fees you pay for advice and fund expenses. Experts recommend keeping costs at 1.25% per year or less, as fee differences can equal 5 to 15 years of 401k contributions. Investors should also beware of the differences between time-weighted returns and dollar-weighted returns when investing in mutual funds. According to John Bogle, the founder of Vanguard Funds, actual investor returns tend to underperform advertised fund returns by about 3% annually. In conclusion, Investing Myths Debunked elaborates on the common myths and misconceptions surrounding investing and the role of fees in investing. The book offers invaluable insights on how to avoid investment pitfalls and establish a successful investment strategy that guarantees a financially stable future. Achieving financial independence. To achieve financial independence, it's crucial to set realistic retirement goals, calculate future expenses, and choose investment products wisely. Annuities are one investment product that can guarantee a lifelong income. Cutting expenses and saving as much as possible is key, including prepaying your mortgage, leasing a less costly car, and eliminating small impulsive purchases. Investing in index funds offers tax benefits and helps reduce investment account fees and expenses. The ultimate goal is to live within your means while enjoying the necessities and luxuries you desire, without letting money control your life. Investment diversification. To achieve a successful investment outcome, asset allocation is key. Investors should diversify their portfolio by dividing their investments among different asset classes such as stocks, bonds, commodities, and real estate based on their risk tolerance, time frame, and needs. The well-known phrase, diversification is the only free lunch, emphasizes the importance of diversifying one's investments. Investors can split their investments between secure choices and those with higher growth potential, such as stocks and bonds. In contrast, residential real estate is not the best option since market bubbles affect its pricing trends. Insurance, first trust deeds, annuities, and structured notes are some assets that offer financial security. Structured notes provide private contracts to investors who lend money to large banks, with a repayment period of 7 years plus interest earned on an index investment. Market cycles may lead to the loss of investment gains, rendering it essential to adjust portfolios over time. One can invest in 7 asset classes across differing markets and maturities while making adjustments to achieve a successful outcome. While many experts recommend investing in low-cost index funds diversifying through stocks to provide broad equity exposure, it is crucial to seek advice from a fiduciary advisor who can create a lifetime income plan that reflects, among other things, the investor's goals and level of risk tolerance. All-weather strategy for portfolio investment. A review of Ray Dalio's all-weather portfolio strategy that achieves an annualized return of 21% since 1991 while keeping risks low, using a balanced approach, and exploiting market inefficiencies. Investing your hard-earned money seems like a daunting prospect, especially given market fluctuations that lead to significant losses. Yet, stopping short of investing means keeping your finances stagnant and missing out on the potential for exponential growth. Therefore, knowing the ideal investment strategy is paramount to achieving your goals, and the all-weather strategy introduced by Ray Dalio of Bridgewater has proved to be one of the most effective. This portfolio maximizes the return while keeping risks low and is based on a 50% to 50% balanced portfolio between stocks and bonds. The strategy acknowledges that stocks carry thrice the risk of bonds and that balancing a portfolio distributes risks evenly. Dalio proposes a 30%-15%-40%-7.5%-7.5% portfolio allocation for stocks, intermediate bonds, long-term bonds, gold, and commodities, respectively. In the right proportion, these assets can help minimize the risks while still providing substantial growth. Notably, this portfolio has an annual return of 9.7% net of fees for the period 1984 to 2013, with positive returns 86% of the time. Moreover, Dalio posits that economic growth, inflation, and deflation are the primary drivers of prices across all investment classes. He further recommends decisions about risk and security of potential investments at every decision point, as risk and gains are interrelated. Dalio suggests that investors should consider portfolio balancing yearly, mainly when some asset classes become more profitable than others. An all-weather investment strategy focuses on exploiting market inefficiencies to keep risks low and achieve maximum revenue. For this reason, Dalio recommends a diversified portfolio that unbundles the myth of correlation and that not all investment classes are unrelated. The 2008 recession, for instance, proved that many asset classes could fall together, shattering this notion. As such, the all-weather portfolio has outperformed 99% of other portfolios globally while reducing potential risks. Retirees or those nearing their retirement age also need to reconsider their investment strategies, keeping circumstances like market conditions and their ideal retirement goals in perspective. Studies indicate that early losses at the beginning of retirement can have long-term effects on savings. Therefore, understanding market dynamics and potential fluctuations is essential when creating a portfolio. Another defensive investment strategy to guarantee lifetime income is the purchase of annuities like the fixed index annuity or private placement life insurance. In conclusion, the quest to achieve an ideal portfolio balance requires careful consideration of market trends and potential risks. While the all-weather portfolio may offer a compelling solution to this problem, it's crucial to consider personal circumstances based on age, retirement goals, and risk tolerance. Ultimately, achieving a balanced approach to investing alongside carefully considered investment tactics may offer the best chance for financial rewards and security. Investment advice from Billionaires. A group of experienced investors offer advice on minimizing losses and maximizing gains. They recommend avoiding risky ventures and staying focused on investments with asymmetric risk-reward. Making informed decisions with incomplete information is crucial, as well as consistently earning, working, and giving. Achieving true wealth. True wealth is achieved through personal growth, balanced living, and a fulfilling lifestyle that benefits yourself and others. The key is to focus on specific goals, break negative patterns, and pursue interests. Money is not the sole factor to happiness. Instead, strive for a rewarding life full of joy and meaning by building strong relationships, helping others, and meeting personal needs. Achieving this type of wealth can lead to a happier, healthier life.
In conclusion, Money Master the Game imparts the essential wisdom to break free from the shackles of financial uncertainty and build a secure, thriving future. Through a step-by-step approach, the book takes you on a journey to discover the power of disciplined saving and investing, strategic asset allocation, and the significance of diversification. As you learn to navigate the road to financial freedom, remember that achieving wealth is not solely about money but also about cultivating a balanced and fulfilling life. These profound lessons will guide you not only in mastering your financial destiny but also in finding joy and meaning through sharing your abundance with others.